Hello, folks. Welcome to Sabres Investments. Today, we're going to talk about AT&T. First, we'll look at the recent M&A activity the company has gone through. We'll also do a DCF analysis, take a look at the dividend, make sure it's safe going forward, and the debt of the company, which is a big topic, which I think is actually a overstated topic, to be honest. But we'll take a look at that here in a bit. We'll also take a look at the stock price and see if it fits with our DCF model. It's a good buy right now. So we're going to start with a DirecTV purchase the company made about a decade ago. That was a bad decision by a company that was trying to go into a different direction than just be a telecommunications giant. They wanted to add media to the business, and the CEO definitely got way ahead of themselves there. Thankfully, that CEO has been replaced, even though the new one's stinky. Has to deal with the past that he was around at the time. When some of these deals were done. Actually, all the deals were done, I believe. And he was a big champion of them at the time. Though it's quite possible he was just doing what his boss wanted him to do, but I digress from that. Anyway, AT&T did have to sell 30% of the company to TPG Group in exchange for about $7 billion in cash. Though AT&T does retain 70% of the business as an investment on their books. So if DirecTV does wind itself down and just eventually go away, as many presume it will, then until then, AT&T will just get 70% of whatever value there is out of the business going forward. If somehow the TPG Group's able to turn the company around into something somewhat sustainable, then there is definitely upside for AT&T to accumulate some cash flow from this business. Either way, time will tell. I'm not too hopeful on it, but it's definitely a possibility that AT&T can come out ahead of the game many years from now if a lot of things go right. Again, I'm not too hopeful on that. Also, T-Mobile and Sprint merged. Now, as we all know, AT&T attempted to acquire T-Mobile earlier in the decade. However, it was challenged in court, and AT&T finally had to give up on that merger. They also had to pay T-Mobile a lot of cash as part of the breakup fee. So they got hurt in a couple different ways here. They had to dish out cash for a merger that never happened, only for a couple years later for that same company to merge with another one of their closer rivals and knock them from the number 2 down to the number 3 spot in their primary business segment. In addition to that, the big one, AT&T purchased Time Warner. Which this of all the mergers, the T-Mobile one made the most sense if it had gone through, but obviously it had a lot of issues with the regulators, and so never had a chance. Time Warner is a much better deal when they bought it than DirecTV. This one made more sense, but it too was challenged in court. Of course, some of that might be political. I'm not going to get into politics on this channel, but some of it might have been politically driven by the people who were challenging the merger. So it delayed the merger for a couple years. So a lot of the synergies and that were expected of it never came to fruition. It never really had a chance. By the time AT&T had it, it wasn't too much longer, and COVID, the C word, happened. So AT&T's never really had a good time with Warner Media. Investors were focused way too much on the debt and on the dividend in particular, which I think is one major thing here is management became focused on doing two things. They wanted to expand from just a communications company into a media conglomerate. At the same time, investors wanted their dividend, and so management was also focused on maintaining that dividend, which this led to the actual issue that AT&T had at the time. It wasn't the lack of ability to pay the dividend. It was the lack of ability to pay the capital expenditures needed for both Warner Media and AT&T's core business in order to maintain themselves as well as keep up with the changing times. 5G, for example, the telecommunications business. You know, when you're fighting for capital with suddenly with the media side of the business, and then at the same time you then have to support this humongous dividend. It just doesn't work out like that. And I think we all learned that the hard way. I do think a lot of people, such as Jim Cramer, for example, way overreacted to the cut of the dividend when Warner Media is being spun out. Honestly, as an AT&T shareholder, I wish that they'd cut this dividend to zero. Now, I know that's not a popular opinion. That's just my opinion. A lot of people have been holding the stock for 20, 30 years. Some families, maybe even longer. I understand that if you really counted on that dividend where it was. But for me personally, they should have cut the dividend much further than they did. But where it is sustainable. And we'll go through that here in a bit. So the spinoff of Warner Media is now complete. AT&T received $40.4 billion in cash and debt. Originally it was supposed to be $43 when the deal was announced a little over a year ago. However, with adjustments, it was reduced a little bit. AT&T shareholders received 71% of the new company, which is 1.7 billion shares of Warner Brothers Discovery. I will talk about Warner Brothers Discovery more in one of my upcoming videos. I was already a shareholder of Discovery with anticipation of the deal, adding to my position there with the spinoff as well, with shares I already had from AT&T. But right now we're going to talk about the first quarter results. Honestly, it's a mess with the spinoff, so it's a little hard to compare it where they were last year to this year once you remove Warner Media from the equation. As a consolidated company, they only had $0.7 billion in free cash flow. But as we'll see here in a moment, the existing AT&T business itself did better than that. So consolidated wise, revenue came down slightly. But as a core, just AT&T business, it actually went up a little bit. Adjusted EPS was down. Cash from operations was obviously down as well, given the change. Cash that had to be paid out for the spinoff. However, the standalone company looks a lot better. Revenues, again, were slightly up versus last year. Adjusted EPS was a little higher. Cash flow from operations was down, though that is anticipated to go back up, according to what the company was saying, especially long term. And we'll look at that a little bit more in our DCF model here in a moment. The big thing was subscriber gains. They're up to 67.5 million postpaid phone subscribers, and overall AT&T fiber subscribers up to 6.3 million, with 289,000 net adds in Q1 of 2022. Both the net adds of the postpaid phones as well as fiber subscribers both were higher in Q1 22 versus Q1 of 21. Now, a big item for them to focus on going forward is their debt. With the $40 billion received from the spinoff of Warner Media, they've been able to announce prepayments of a lot of debt going out over the next 5 years. Most of it was prepayments of this year, though the decent chunk is from 2023 through 2026, as we can see on their chart. Everything in the light blue here are prepayments that are going to be made shortly, leaving only a small amount of debt for the rest of the year. Decent manageable debt towers in 23 and 24, drop off in 25, and then one last large tower in 2026 before averaging out to $6-7 billion a year, which is easily sustainable with their current cash flow. So now we're going to take a look at a DCF model. First, we're going to include guidance by the company into this DCF model. I originally did the model without this guidance and then adjusted based off of this chart that was provided from AT&T. They announced this during their Investor Day presentation, which was interesting to watch. I do believe that they are focused on turning this company around and getting back to where they should be. They're going to be investing a lot of money, a lot more CapEx money into the business. So take a look at my DCF model. First, I assumed a 1% revenue growth through 2026. and EBITDA percentage of revenue conversion of 30% in 2022, and then up to 32% after that. The increase is due to the cost savings the company expects to maintain. Interest expense is going to go down as debt is paid off. Now, one thing you will notice is I do not include any debt issuances in my DCF model. I assume the company cannot issue, any debt. So it's kind of a stress test I put companies through when I do my DCF models. I give them credit for debt payments that they have to make. I'm not going to give them credit for any other payments. In this case, AT&T, they did announce some prepayments as we showed. So that's the adjustments I made in green to my DCF model. But typically, I do not do that. I just take what their debt payments are supposed to be, throw them out there, assume they cannot issue any debt to refinance that existing debt, and that way I can get a free cash flow to equity model that's based on what the company has to do in a stress situation in which they cannot go to the bank and ask for more money. So I also left the EV to EBITDA level at 7.3 times, which is roughly where they are now. I think actually a little higher than they currently are, but where they were at the end of the year, 2021 on their 10K, is 7.3. In all honesty, I do expect that to expand a little bit, but I'm going to leave it at 7.3 just for this model. So with that, I first had to remove the Warner Media from the equation. That way my system could calculate up to the new revenue figures for the new company. So we're going to have quite a drop off from 168 down to 134 billion dollars in revenue. But EBITDA, I figured, will be in about the 40 to 45 range over the next several years. Take out some depreciation, interest, which theoretically goes down in my model, assuming no more debt's issued. It obviously would stay higher, assuming debt is issued at some point. So that does skew my model a little bit, unfortunately, but it's not as big of a hit. So net income about 12.3 billion, up to about 16 billion. With depreciation covering a lot of that additional cash flow we'll see later in the company. I did adjust the cash figures for the money they received from Warner Brothers Discovery. I added that to the short-term investments so it would not affect my enterprise value model. I want to take that out because I assume that excess money is going to go toward debt payments. So I don't want to leave it on there as actual cash the company can use for something further down the line when it's going to be used up pretty quickly. With that though, the same adjustments to debt, this is the end of year total on my model. Now I did adjust for the announced prepayments since it was more this year than they originally were scheduled to make. I believe there were about $18 billion they had to originally make. They've announced quite a bit more than that. So they are prepaying debt early, and I did give them credit for that in this model. I also had to adjust the capital expenditures, which were a lot higher, given the manager's projection of $24 billion spent over the next 2 years. And they said they would taper it down by $4 billion after that. So what I did is in 2024, I just shaved $4 billion off that and left it flat after that at $20 billion. And with the debt repayments you saw down below, the final figures, we do have a negative free cash flow to equity this year of almost $10 billion. However, it does return to solid numbers of $12 to $16 billion, with 2025 being much higher just due to lower debt payments. Now, again, this is free cash flow to equity, what I use in my model. The free cash flow to firm, which is what most people refer to as free cash flow, does match roughly where management's guidance is. Management's guiding $16 billion for 2022 and $20 billion for 2023. So I just left my numbers in there because they were close. With the reduction in CapEx after that, it does jump up quite a bit to about $24 billion a year. So we'll go back down here. This is my WACC calculator with the numbers I used to create this. So I gave them a weighted average cost of capital of 6.4%. Apply that to the model, and it gives me a net present value of 47.53. My 7.3 times EV to EBITDA gives me a 29.53. So by cash flow, the company is worth more value than shareholders are currently giving them credit for on the street. So I do believe that the stock is underpriced right now. If you merge these two at a 50-50 rate, you get a fair value of 38.53. I use a 25% safety margin, which knocks us down to 28.90 per share, which is well above where the share prices are now. So under the model I use for my investments, because I simply use WACC, weighted average cost of capital, that's what I use when I decide if I want to buy a stock. But we'll change this WACC to we'll put a 10 in there, because a lot of people just use a flat 10% rate of return. Adjusting that still puts the net present value at 22.68. Now, that does mean that it's actually suddenly underneath the current value of the equity model. So it does change that around a bit. However, when you average them out, the fair value is 26.11, which is still above the current price. And with my margin of safety, it's 19.58. So right around where the stock is right now. So with the margin of safety, even at a 10% discount rate, it looks like the stock is either fairly valued at that or under the model I normally use, which is just straight WACC. It's significantly undervalued. Either way, I personally think that the stock is a buy, and I do own over 1,300 shares of the company, and we'll hold them. And if the stock dips a little bit, I'll definitely look into buying $3,000 or $4,000 worth of shares if I can, to get up to a slightly overweight position in the company. I'm not going to go much further than that, just due to my own personal resources. Believe me, if I had more money, I'd be putting a lot more into this stock right now. But we'll take a look at that dividend just to make sure it is safe. Down here is a lot of the numbers that were up top just dropped down and then slightly modified. Basically, the cash is adjusted based on the change in total cash flow here, which we'll show here in a second. So we have our free cash flow to equity, which was the number we dropped down from the top. These are the same numbers we saw earlier in the DCF model. All these numbers that are not highlighted in green are the same. Then we add our $1.11 a share of annual dividend. Gives us just under $8 billion that we pay out every year. And this assumes the dividend does not change at all for the next several years. With that, once you subtract the dividend from the free cash flow to equity, we're a negative $17.5 billion a year. That's going to come out of our cash pile. And that's where that excess cash actually ends up going. Basically, the pre-announced debt that can be prepaid, I don't see AT&T announcing too much more now, because the rest of the cash they receive from Warner Brothers Discovery has to be used in order to pay for this deficit in free cash flow to equity. So the numbers I'm seeing and what they're doing are jiving very well. So then going forward, 2023 we return to positive, basically after paying CapEx, paying the dividend, paying the debt. We still have $4 billion left over to add to the cash pile in 2023. And it'll improve from there, including 2025 when the debt tower is a little lower, to about $10 billion. So all told, from 2022 to 2026, we end up with about $7.5 billion to add to the checking account. Now, excluding the initial $17.5 billion in 2022, you're actually talking about $25 billion from 2023 to 2026. And that's the key right there, that $25 billion roughly that the company will be able to use for, hopefully not more mergers and acquisitions, but in my opinion, a stock buyback. That's what I want them to see, is buy back the stock. I don't want them to see a massive dividend increase to get right back to the situation they were in before. I want them buying back stock. Get that uh, stock count down from over 7 billion to 6.5, maybe even a little bit less, preferably depending on what the stock price does. But I mean, we could shave 7, 8, 900 million shares off the share count would be great. And with that, you could actually increase the dividend using the savings from the reduced share count and just end up paying the same $8 billion every year in dividend as a company, but on a per share basis, your dividend will go up. So as an existing shareholder, you should be happier with that while I'm making a much more sustainable company. And again, this is assuming the company issues no debt at all. If the company issues any debt, which they will, they will, then that cash pile is going to go up higher. And if you look here, the my ending net debt to EBITDA in 2026 is 2.1. I think the company is aiming for about a 2.5 before they start buying back stock or anything else, which they should get to sometime in 2023, 2024 at the latest. And with that, at that point, they could start issuing more debt. And, half of, if the EBITDA is at $45 billion, half of that's roughly $20 billion. So if they issue debt and just even use that for additional stock buybacks, or to cover additional capex if they saw really good opportunities to expand and improve the business, I'm not opposed to that either. But if they can't find anything good and get a very good rate of return internally, then definitely just buy back stock. That's got to be their focus for the next few years. But with that, let's take a look at the stock price. So again, right now is 1951 was the close today, April 25th. So again, it's under my 25% threshold for margin of safety, even with at a 10% discount rate. But the stock was all the way up, and this chart was the Yahoo Finance, so it's adjusted for all the spin out of Warner Media and all that. But it was at a high of 30 pre-spinoff and everything. It was actually, this chart would have shown it about $40, I believe. But that was just back in 2019. So within the last couple of years, it was twice the current price. Then we had the drop down for the C word. Went back and forth, and I actually started buying the stock a little somewhere right around it here is when I personally started buying a few shares, just because I thought the company was going to do better, and it did. With Warner Media, with HBO Max, it was pretty obvious the company wasn't going to be number one in either industry, but it could be top three. It obviously was in telecommunications, and could have been easily top five and stayed there in the media segment. And combined, I figured there were some synergies and all that, so I started dabbling in the stock then, hoping that the HBO Max would do well. It has. It actually has exceeded my expectations, in all honesty. And initially, when the spinoff of Warner Media was announced, I was a little disappointed, a little excited at the same time, though, because the view I had of the potentials for AT&T going forward were obviously dashed. But I don't think some of them were completely realistic either. I think the company's much better set off as a separate company. And so with that, I do believe right now is a good opportunity to buy this stock. I'm definitely holding what I have. I have been adding more since the Discovery merger was announced, or spinoff was announced, and it dropped down. Once it started hitting the mid-20s, I started buying hand over fist, and I easily tripled the position I had. And like I said, I have over 1,300 shares now of AT&T, and I also began buying Discovery shares. So between what I purchased in Discovery and the spinoff from AT&T, I have about 1,300 shares of Discovery as well. So there's our rundown of AT&T, a little bit of the history, my DCF forecasting model, Bottom line is the dividend was cut. It needed to be cut. I personally think it should have been cut more, but the dividend where it is fully sustainable with the debt load that AT&T has. Um, AT&T can definitely handle the dividend and the debt that's on their books now. I think the barring literally a 1929 depression level event, AT&T is definitely a beacon there that everybody should be at least taking a look at, and not just seeing a debt pile number, and actually go look a little more in depth and see that the company can handle it. And that was the primary focus of this video. The reason I made it was to point out that the debt can be handled, the debt and the dividend as it is can be sustained. But if the dividend had been cut, we could buy back more stock, and that's definitely what we need to do, is buy a lot of stock back. So anyway, thank you for listening. Like, comment, and share. Thanks.